Welcome into EP Wealth Advisors Informed Investor Market Update. I'm Rob Black. Joining me today, Managing Director of Investments for EP Wealth Advisors, Adam Phillips. Let's do a quick report card. We're maybe pushing 4 weeks into the new year, so it's still early. But look at these numbers. The S&P Midcap 400 leading the pack up 5% year to date as of Friday's close. The Dow Jones Industrial Average up 4.4%. Little different than last year, right? The S&P 500 up 3.7%, the Russell 2000 up 3.5% year to date, and the NASDAQ up 3.3%. In general, I'm seeing these as really good numbers for the first month of 12 months of the year. Adam, how are you seeing these numbers, and what do they tell you what's going on in the market?
Yeah, well, look, it's a great start to the year, especially after what we saw last year and the year before. We've continued with this strength within risk assets, in particular the equity markets. I think what's really notable is that obviously we had President Trump's inauguration last week, and so this was the first week of his second term, and the markets responded favorably. And we can talk a little bit about what that is, but let's just acknowledge that the S&P 500, if we use that as the measure of broad market strength, up close to 2%. That was the strongest first week of a new presidential term since 1985. So let that sink in. Really, really strong. Whether this is indicative of what we're likely to see here over the next 4 years, I don't know if I would go that far. But let's just talk about why the market continued to rally last week when President Trump took office. I think a large part about that is because he announced a number of executive orders. And I think many were maybe on guard. They expected him to come out swinging on things like trade policy and immediately announce tariffs or changes to trade policy. Now he threatened them, and but he said, in the case of China, he said, "Look, I don't want to do this. I don't want to resort to this. Let's see if we can avoid it, and let's give them until February 1st to figure this out." He did the same thing with Mexico and Canada. And so that February 1st is that date that we're all watching right now, which is it's coming up fast here.
Coming up
But the
fast.
fact that he didn't just do it immediately right out the gate suggests that maybe this is, in fact, what many were hoping would be the case. It is, in fact, just a negotiation tactic. And so we will see, but that's really why you saw markets respond the way they did.
So I'm seeing the S&P Midcap 400. I want to ask you a little bit more about this because recently it's been the S&P 500, the Magnificent Seven, heavily weighted, the NASDAQ that have been the outperformers. For me to see the midcaps creeping in, it's telling me diversification, maybe a broadening of the market breadth. Am I kind of marking up the right tree there?
Yeah, I think you are. And look, mid caps, small caps, as you look down market, these have lagged the last 2 years. But let's just, if we were just to look at absolute performance, small cap stocks, mid cap stocks, they still did deliver double digit returns in each of the last 2 years. It's just that they lagged the S&P 500. It's because they don't own those Magnificent Seven companies and those big high flyers. And so on a relative basis, they don't look so hot. But it's really, really important to acknowledge that leadership changes over time. And so just because we saw over a couple of year period that these asset classes did underperform relative to their large cap peers, doesn't mean that you want to avoid them altogether. These things will change, and even though we do have a slight underweight in our positioning across portfolios, and underweight simply means how are we positioned to relative to how we would be in a quote unquote normal environment. And so we have a below target weighting currently. But we still want to have some skin in the game. And so we're not completely avoiding these areas. And so I would expect that we will continue to add here over time because we do think in a healthy market that is not led by just a handful of companies, you should expect broader performance. And when the economy is strong, as we believe it is right now, it's on firm footing, these areas should continue to do well. And so that is why we don't want to avoid them altogether. We don't simply want to look at recent returns and think that these are going to continue to lag large caps. We do think that there is a rotation that's likely to happen at some point. And part of that is simply because we do expect this reversion to the mean. At some point, if larger companies continue to outperform, on a relative basis, they're just going to be too expensive relative to mid cap and small cap. And so these things tend to correct themselves over time. And that's why you still want to have some exposure there.
No, I think that was one of the bigger questions, and I want to almost hit this twice today with you. Last week during the first quarter um, outlook that you give every quarter for EP Wealth Advisors and our clients, there were some questions that were coming in on like almost angst that people don't want to own small cap and international because as asset classes, they've been underperforming in the short term. Um, and people almost have that fear of missing out, the FOMO. They kind of want more of the same thing. Thoughts on how do you tamper angst, or how do you tamper that emotion of greed and fear, and how they
Yeah.
kind of combine to hurt, not hurt, but how they kind of combine to mess with investors' heads like myself.
Look, it's really easy, and I think we're constantly fighting our own emotions and psychological biases when we're investing, and that's why we do rely on our investment committee to kind of keep each other in check,
Okay.
because that we know that the emotions can come into play, and I think our clients are relying on us to remain disciplined. And keep the emotions out of it. And so we're having conversations and talking not just about recent performance, but what are those catalysts going forward? And why should we, what does history suggest, number one, in terms of how these things do move in cycles over time? And what are the valuations on a relative basis? What are those catalysts that could lead to that leadership change or rotation over time? And so those are the things that we're talking about. We still, as I mentioned, as you look at small caps, we still have an underweight there relative to where we would normally be. But and part of that is because look at the level of interest rates that the Fed is meeting this week. I'm sure we'll talk about it, and they're likely to keep to not cut interest rates as quickly as many had hoped several months ago, because the economy is on such strong footing, and they're worried about inflation reasserting itself. And so that environment where rates are elevated for longer just continues to put a little bit of pressure on these smaller companies that don't have the balance sheet strength to withstand higher rates. And so that's why we still want to be a little bit cautious there, but have skin in the game. On the international side, we know that this environment where it is this environment of U.S. exceptionalism, and one where President Trump is really focused on America First policy. We know that just the headline itself suggests that U.S. is going to continue to be the place where continue to be leadership on the global asset class level. But that doesn't necessarily mean that's we have a slide in the market outlook deck that says, the most obvious trade doesn't always work. And we point at how different sectors and asset classes performed during different presidential administrations, and it didn't really work that way. And I think that's why, even though it seems to make sense in our head, you don't necessarily want to put all your chips on one market. These things do change. They have different economies, they have different leadership and monetary policies that they're working towards, and so there's just different drivers. And I think we need to acknowledge that it's a lot more difficult than simply saying there's a new president in the White House and let's just lean into U.S. I think you really want to be thoughtful there and make your bets at the margin.
So let's talk about what I think was a crazy weekend. I do financial media. I'm not your level of knowledge in any way, shape, or form, but over the weekend, Twitter went crazy, or X went crazy, with kind of a Sputnik kind of moment, as Mark Andreessen referred to it, where last week President Trump announced $500 billion of initiatives or ideas of forming together with OpenAI, Oracle, and SoftBank, doing big investments into AI in the United States to make us number one, to keep us number one, the United States. Um, and then this weekend, we learned China may be ahead of us. It was a Sputnik kind of moon moment where uh, DeepSeek, which many people have never heard of, has better processing power or more efficiency for less cost,
Yep.
for less research than what OpenAI has. And uh-oh, Monday was a day of reckoning for a lot of these companies, whether it be the energy companies that are going to power data centers, or it's the data center makers, or the semiconductor companies like NVIDIA and Broadcom, all waking up to a new reality this week. Thoughts?
A lot of thoughts, a
A
lot
lot
of
of
thoughts,
thoughts,
Rob.
right?
Look, this is we're still processing this one. But I would say, look, it's healthy. I think that as investors, we were always the reason that we didn't want to assume that NVIDIA's dominance was going to continue forever is because this naturally creates competition. Their success not naturally breeds competition. We've seen that time and again in recent decades. And again, tying it back to the market outlook, there was a slide I had in there a couple quarters ago that showed how the top 10 companies in the S&P 500, it changes every few years. You
Yeah.
see this turnover because once these companies crack the top 10, they tend to see competition. And so they start to maybe underperform relative to the rest of the market and cede that position. Now, it's not to suggest that NVIDIA or any of these other chip companies or AI plays are going anywhere. These are still quality companies that are growing, they are producing cash flows, they're highly profitable. So we're not necessarily worried about that, but I think what we're seeing right now, NASDAQ, I'm looking at my screen, down about 3.5%. Just today alone, NVIDIA down, as we're recording this, about 16%. So just in a day, if it closes at this amount, at this level, it will have shed close to $500 billion in market cap.
Wow.
So just under a $3 trillion market cap. So it's still huge, but to think that it could shed basically the value of ExxonMobil in a day is pretty amazing. Now, what we're all trying to figure out here is, okay, is this are people overreacting? Are they simply are they going to shoot first, ask questions later? That could be part of this. But if you just take a step back, I think that this is something that we've all been thinking about, and why we didn't want to lean into this AI trade or some of these recent winners too heavily, because at some point you will see this competition. It will lead some to look for other ways of doing it for better, faster, cheaper. And so I think that's why we aren't too surprised. I think it's just another reminder that you want to remain diversified. And so we are looking at today's move. And even though we never want to see stocks in the red, or certainly this deep in the red, we're comfortable because we're diversified investors and we know this isn't the only stock that we own. I would say that I'm looking at the trade action today, and what gives me I guess what gives me some sense of comfort is that the Dow Jones Industrial Average is actually, it's positive today. It's in the green, just barely. It's up 0.1% as we're recording this. But that suggests that there is broader market strength. And some of the areas of strength right now in this market are software companies, an area that we have exposure to. When you think about it, companies have the potential to take advantage of artificial intelligence in a cheaper, more efficient way, then they're going to benefit. And so on the whole, even though it's a negative for some of these companies that might cede some of their leadership, it's a benefit to the majority of the market, to the majority of companies outside of these semiconductor plays. Again, I think that speaks to why we could see a broadening out here in terms of leadership, and why we want to remain diversified as investors. So that's really, I guess, my positive spin on things here.
I grew up in the 80s and 90s, and I've seen this before. The PC market was a $4,000 PC, then it was a $3,500 PC, then it was a $3,000 PC. There was companies like Dell, Gateway, and Compaq, and where did Gateway and Compaq go? And HP's just not relevant anymore. So we've seen it before. Smaller, cheaper, faster does happen in technology, without a doubt, and we're seeing it in a very humbling way for some semiconductor companies today. So that's enough on DeepSeek, I think. Let's talk about, again, broader market issues, maybe economic issues. What is on your radar this week that we need to be aware of, Adam?
Yeah, it's look, the week started off with a bang for sure, and it's really going to pick up here in the next couple of days. Really, the big one is on Wednesday. We
Okay.
have the FOMC meeting, so the Federal Open Market Committee meeting, starting tomorrow, Tuesday, and it's a 2-day meeting, so it'll finish up on Wednesday. The Fed is not going to cut rates or make any take any rate action in the meeting this month. But what we're all focused on is really the post event press conference, where Jay Powell, as he always does, takes questions. He delivers his prepared remarks on behalf of the committee, and then also takes questions from reporters. I think that's going to be really interesting. It's what we're finding is that it's a hard tightrope to walk when the Fed is saying they're data dependent, and they focus on the data, they focus on the numbers that they're seeing. And what we started to hear over the last in recent weeks is that they're also maybe deviating a little bit from that and focusing on policies that might be coming with this new administration. Policy changes like immigration reform, like trade policies and tariffs. Be they are even they are starting to acknowledge some of those things because of what they might do for economic growth, for price levels and inflation. And so I think that's really interesting and why I expect them to kind of keep some optionality here, even though they're not going to cut rates at this meeting. They'll likely say that they're continuing to watch the data. It's supportive of maybe continuing to cut rates over the next in the next couple of months here, but they're going to wait and see how certain things play out. That's the message that I expect. It's very hard to deliver that, though, in a balanced way, and so we'll see. I also expect that Jay Powell will get some questions about the level of influence that President Trump might look to have over the committee and over the Fed. He made comments last week that suggest that he's advocating for lower interest rates, that he knows interest rate policy better than the Fed and Jay Powell. That one was an interesting one to hear. But I would imagine that Jay Powell will get that question certainly in the press conference on Wednesday. Enough about the Fed. The other stuff that we're watching is it's a big week for earnings. So staying on this tech theme, but putting the deep seek aside for now. That's a tough one to say. We get earnings from Microsoft, Tesla, and Meta, formerly Facebook, on Wednesday. So those are big ones. I would expect them to make some comments around this new technology because they've been focusing on so much capital deployment and expense on leveraging AI technologies. And so we'll see what they say about this. On Thursday, we get earnings from Apple. And then next week we get earnings from Alphabet and Amazon. So it's going to be a lot with tech here in the next couple of days.
I want to go back to the Fed. I know you're ready to put it to bed, but last week when President Trump said that he wants to see lower interest rates, correct me if I'm wrong or give me a little bit more color if you could. Doesn't the Fed only affect short-term rates and like the rest of the bond market and the treasury market kind of figures itself out with flows of cash coming in and cash coming out and changing the rate that way? Does the Fed have any? I mean, can he? He's not going to be able. I'm going to let you talk. I just feel like the Fed. I think this seems like a weird fight for me.
It's a weird fight on a number of levels, but I think what Donald Trump is hoping is, yes, that the Fed does set short-term interest rate policy. They don't impact mortgage rates, anything like that. All that stuff is based on the economic outlook, the inflation outlook,
Okay.
and so those have different drivers. What I would be worried about is if the Fed is pressured into cutting short-term rates, and that leads to, and then we see the economic data remain supportive, that leads to higher inflation expectations, which could actually make those long-term interest rates move higher and work against the Fed. Or excuse me, work against what President Trump is actually going for, right? That's not going to do anyone any favors if long-term interest rates shoot higher because inflation expectations are increasing. So that is what I'm on the lookout for sure. I don't expect that that Jay Powell or the Fed will yield anything to President Trump. They are independent, and I expect them to remain that way. But just having those types of comments, it's not helpful for sure. I'd like for them to just be able to focus on their job, but I don't expect that that's the environment we're going to be in here.
Well, some people find football to be super entertaining. I find money and economies to be super entertaining, especially this week. What a week. What a day to start Monday off like this. Thank you very, very much. He is Adam Phillips, the Managing Director of Investments at EP Wealth. I'm Rob Black for the Informed Investor Market Update. Good day.